TotalEnergies SE, ticker symbol TTE, is a French multinational integrated energy and petroleum company founded in 1924 and is one of the 7 major oil companies. In terms of turnover and profit, it's ranked 3rd out of the big 7 companies. Only ExxonMobil and Shell are above it. They produce and market oil and biofuels, natural gas and green gas, renewables and electricity, and have an integrated business model, meaning that they are present throughout the entire chain, leading to efficiency, innovation and profitability. TotalEnergies stock price has been on the rise since the pandemic drop at the beginning of 2020, hitting a 52-week high of $65.05 in April. The last time it hit that was back in 2018. It's had a 52-week low of $44.61. The yield is currently 5.17%. Looking at historical data, dividends have been consistent with regular increases. A very minor drop in 2020 from 0.68 to 0.66, but back up and above from 2022, plus a nice special dividend on top, which more than makes up for the minor drop. The total return CAGR for the stock is 22.96% over the past 12 months. The 3-year is 22.52% and the 5-year is 3.47%. Total return includes any dividends being reinvested. Compared to the competitors, it's performed reasonably well. The last 3 years have seen its biggest growth. ExxonMobil and Petroleum Brasilia, I think I'm pronouncing that right, have been the big winners. Well done to anyone who've bought shares in those companies, some fantastic gains. Let's have a quick look how it's performed against the S&P. In the last 10 years, compared to other stocks we've compared recently, it has performed surprisingly well. If you invested $10,000 and reinvested the dividends in that time, the value of your investment would be $20,802.84. That is a total return of 107.97% and an average annual return of 7.6%. The S&P doubled the total return with an average total return of 12.39%. Something to think about when you're choosing your investments. The financials. The market cap is currently $129.8 billion. Payout ratio is only 41.04%, which is actually lower than I thought it would be. So the dividend is easily safe and lots of room for growth. Cash to debt, net debt is $14.93 billion. Energy companies have done really well over the last 2 years as oil barrel prices reached all-time highs. Household utility bills also soared, so it's no surprise to see how well it performed. All the stats that you want to see in an upward trajectory there. Revenue jumping from 184 to 261 billion. EBITDA, net income and EPS also up. Looking at free cash flow, they have never had it so good. If we switch to recent quarters, there has been a significant drop-off to normalised levels. Surprisingly, net income and EPS have still risen. Share buybacks up and down. They plan to buy 2 billion shares in the first quarter. In Q1, they had strong results considering the lower oil and gas prices. It beat Zach's estimate of earnings per share by 7.4%, but the bottom line was down 23% in year-on-year. First quarter revenue also down by 8.7%, but again expected given the lower oil and gas prices. Now, what do analysts think the 12-month forecast of the stock price could be? CNN Business have a 12-month average price target of $71.17, 20.8% upside from where we are today based on 27 analysts. TipRanks have an average buy price of $74, 25.57% upside based on 3, and Zacks have an average buy of $70, 18.78% upside from where we are today based on 5. You should take what analysts say with a grain of salt. That's a lot of upside potential and would see some significant gains. If we go over to value investing, I've had a look at the intrinsic value and what it could be, and the results show incredible upside. Given the last 2 years' surge in prices, the value has been distorted. The dividend discount model shows 77.6% upside. Trading multiples, 0.6% downside, so a big difference in fair value. Alpha spread has a worst case, base case and best case scenario. Even in the worst case, there is minor upside, with base and best significant upside. If I was being conservative, given the worst case and a 20% margin, that would be a buy price of $47.77, which is still above its 52-week low. There is always going to be opportunities to buy the dip. It would be a fairly good compounder and a solid choice for dollar cost averaging.